What is liquidating your credit card? Credit card liquidation. Liquidating a credit card refers to converting the available credit limit into cash or an equivalent form that can be used outside regular purchases. Typically, credit cards are designed for transactions at merchants, but some users seek ways to access cash from their credit limit, either through cash advances, balance transfers, or third-party methods. While this process can provide immediate funds for emergencies or business needs, it often comes with high fees, interest rates, and potential risks. Understanding the implications, legality, and alternatives to credit card liquidation is essential to avoid financial pitfalls and long-term debt traps. Methods of liquidating a credit card. There are several ways to liquidate a credit card, some of which are legitimate while others can be risky or even fraudulent. The most common method is a cash advance, where the cardholder withdraws cash from an ATM using their credit card. Another method is a balance transfer to a bank account, though this depends on the bank's policies. Some people purchase goods or gift cards and resell them for cash, though this can be cumbersome. Other high-risk methods include using money transfer apps that accept credit card payments and then withdrawing funds, which may violate the platform's policies. Costs and risks involved. Liquidating a credit card is often expensive due to various fees and high interest rates. Cash advances typically come with a transaction fee of 3% to 5% of the amount withdrawn, along with an APR exceeding 20% that starts accruing immediately without a grace period. Additionally, some banks charge a higher interest rate for balance transfers if used as a form of liquidation. Furthermore, alternative methods such as reselling goods or using digital payment services may result in account suspensions, fraud risks, or transaction limits that could cause financial losses rather than gains. Legal and ethical considerations. While some forms of credit card liquidation, such as cash advances, are legal, certain methods may violate bank policies or local financial regulations. For instance, misrepresenting transactions to bypass restrictions can be considered fraudulent behavior. Additionally, engaging in structured money transfers to cash out credit can result in account closures, penalties, or even legal consequences if deemed suspicious by financial institutions. It's crucial to understand that banks monitor irregular activities, and any attempt to manipulate credit card usage outside its intended purpose could lead to serious repercussions. Alternatives to liquidation. Instead of liquidating a credit card, users should explore safer financial options. A personal loan often comes with lower interest rates and better repayment terms compared to cash advances. If urgent cash is needed, a credit line from a bank or a buy now pay later service might provide a more affordable option. In cases where a credit card must be used for liquidity, choosing 0% APR balance transfer cards can help reduce financial burdens. Budgeting ahead and maintaining an emergency fund can also prevent the need for high-cost liquidity solutions. Who typically uses credit card liquidation? Credit card liquidation is commonly used by individuals facing financial distress, business cash flow shortages, or unexpected expenses. Some freelancers and entrepreneurs use it as a short-term funding solution when awaiting payments. Others resort to liquidation when traditional borrowing options, such as bank loans or payday advances, are unavailable due to bad credit history. However, it's more frequently seen in people struggling with debt, often leading them into deeper financial trouble rather than providing a sustainable solution. Understanding one's financial situation before opting for liquidation is critical. Final thoughts on credit card liquidation. While liquidating a credit card can provide quick access to cash, it is often an expensive and risky financial move that should be carefully considered. The high fees, immediate interest accrual, and potential legal issues make it a last resort option rather than a standard financial strategy. Individuals should weigh the costs against alternative financing methods and prioritize financial planning to avoid the need for liquidation. If faced with financial difficulties, seeking debt counseling, negotiating with banks, or improving credit health can provide more sustainable solutions for long-term financial stability. Thanks for watching the video. Please subscribe.